Navigate to the Input Income Statement tab. Fill in information from your financial statements, starting from 5 years back. If your statements don't go back that far, use the most recent year. Over to the far left here, we have a set of blank cells. This is where you will input your line item expenses taken from the financial statements. Type in all of these, then begin filling in the data. What I'm filling in here won't match your financials exactly, but this is the process that you should follow. Note that rows 10 through 19 are fixed and shouldn't be replicated below, as these expense accounts have unique ramifications on the value. At the bottom here, we have gains and losses from assets sold, which goes in non-operating income along with items such as foreign exchange and investment income. Put your income tax back up here at the top, and then double check that the company's stated net income lines up with your financial statements. For Canadians, many of your accountants will show depreciation of both tangible and intangible assets as amortization on the income statement. If this is the case, separate out the depreciation of tangible assets and place it under depreciation, as it is used in the calculation of capital expenditure. A fully complete income statement should look something like this. Going over to the Input Balance Sheet tab, we see a similar series of inputs. Place all assets on the top here, and liabilities and equity below. If any assets have been sold in the same year, place the gross book value of assets sold right here. This should have an entry if a gain or loss on assets sold was recorded in the same fiscal year. It's likely that you don't have this information yet and have to ask the accountant, but it is something that needs to be done before completing the valuation. Do not, under any circumstances, add or delete rows. This will seriously compromise the workbook and formulas throughout it.